the idea of economic growth is a complete non sequitur. It's not economic growth at all. It's growth in the quantity of money in the economy being deployed. And obviously the purchasing power of that money is the thing that matters. And the more money you put into the economy, the lower the purchasing power of each individual currency unit. So you can forget that GDP, which everybody targets, is actually meaningful. It is meaningless. Really, I think what people are confusing it with is economic progress. Now, progress, I think we can define as an improvement in the condition of the average person from, if you like, the march of technology, of profit-seeking entrepreneurial success, and so on and so forth. Those are the things that contribute to economic progress. It is not, as everybody thinks, wrapped up in a GDP number, which is simply a monetary total. Money doesn't tell you how it's spent. It doesn't tell you the quality of what it is buying. It doesn't tell you whether or not it's improving people's lives. And I think that's the point which everybody really should hoist on board. And I would urge your listeners, your viewers, to go to that article and read it through and really make an attempt to understand the distinction, because it is desperately important, because it is leading to a major policy error. Well, the first thing to note is I have one chart, which is figure 1 in the article, which shows the growth of GDP and the growth of M3, taking that as the broadest measure of money, which I know that the Fed doesn't follow anymore, but it is actually compiled by the IMF. So those figures are available. And I've rebased them to an index of 100, and I've put it on a logarithmic scale. And you can see that until about 1990, I think it was about 1990, they actually moved very much together. Then after that, you found that M3 didn't keep up with the growth in GDP. Now, that gap, to a large extent, I believe was due to the emergence of shadow banking as a major factor in the economy. Because 1985, we had Big Bang in London. Wall Street followed, deregulating banks in the sense that Glass-Steagall was thrown out the window and all the rest of it. And the hedge fund industry started going. And that was, if you like, an indicator of what was going on in the shadow banking space. Because, again, falling interest rates over that period meant that everybody, all the major institutions in the system, sought ways to increase their income because of the declining in interest rates. And one way of doing this was shadow banking activities. Okay, well, shadow banking in the widest sense is the recycling of money, if you like, through money and credit, or currency and credit, through various institutions. And these vary from money funds to pension funds to insurance funds to investment management outfits, to collective investment schemes. I mean, the whole plethora of if you like, the financial establishment recycles its money, and some of that, only probably a fairly relatively minor part of that total, is involved with the creation of credit, and it's that bit that we really we really want to focus on. To give you an example, I remember well in the early noughties, we had banks would issue funding, or funding limits rather, off balance sheet. We'd get a vehicle quoted, say, on the Channel Islands Stock Exchange for $1 trillion. Hold on, this is huge. This is absolutely enormous. But what it meant was that they could use this as off-balance sheet finance to expand their amount of lending for profits on the bottom line. And all sorts of banks were doing this. I mean, particularly around Europe. They were also doing it in America, and roughly 40%, I think, in the early days of shadow banking. The shadow banking was in the United States. And I'm going on figures which are compiled by the Bank of International Settlements. So if you like, if you take M3 and add in a factor for the credit creation aspects of shadow banking, then you can see that the red line on my chart, which is of M3, would actually marry up with the blue line, which is GDP. We then had the financial crisis, 2008, and at that stage, there were changes because with the collapse in the stock market in particular, that meant that the size of shadow banking fell. Not only that, but the securitization, some of them failed completely. These were securitizations of mortgages. They failed completely. And furthermore, the regulations changed, which meant that a lot of the shadow banking, which was off balance sheet, off the bank's balance sheets, was brought in. So we had a situation really where it was a combination, if you like, of the figures being more accurate as far as the statistics are concerned, and at the same time, an enormous monetary stimulation by the Fed. Remember that the Fed was starting doing QE quite seriously in the wake of the Lehman crisis. So at that point, M3 started growing more rapidly than GDP. And we then go up to September 2019 when we had the repo crisis. And, most people have forgotten about that. Why? Because it was beautifully covered up. I mean, we were aware that suddenly the repo rate jumped up to 10% and then the Fed came in and pushed it down. Panic over. So, that was a 5-minute wonder. But actually, it was extremely important. It would mark the beginning, if you like, of the destabilization of international banking, because the banks that were involved in that were basically Eurozone banks, in particular Deutsche Bank and BNP, the big French bank, because Deutsche Bank sold its prime dealership to BNP. And that was the day in which ownership actually changed. That was what drove, or it was a pure coincidence perhaps, but I don't believe in coincidences except as a last option. That was the day in which, in that September, the repo rate jumped suddenly to 10% one morning and was then jumped on. So that was the first sign, if you like, of a banking crisis in the making. And we then go on from there. We had a crash in on the S&P. I mean, it fell, we forget. But I think between something like February the 8th, 2020, and around about the 20 to 23rd of March, a period of 5 weeks or something, 5-6 weeks, the S&P lost fully 1/3 of its total index value. I mean, a whole 1/3. And it was then, of course, that, first of all, COVID was really beginning to undermine things. And that March date was when the Fed decided to cut interest rates, its Fed funds rate to zero. And it then followed that with QE of $120 billion every month, which is monetary injection into the system. Now, at that point, the relationship between M3 money supply and GDP, M3 just took off relative to M3. And it is now, I mean, I've got this on a logarithmic chart. And I think from memory, we're looking at figures like M3 is running at something like 1,500 on this indexed chart, whereas we've got GDP at around about 700. So there's a huge, huge gap. Now, that indicates the amount of monetary inflation which is in the pipeline yet to be reflected in GDP. It tells us two things. It tells us that nominal GDP, I mean, forget what the economy is doing, nominal GDP is going to outperform everybody's expectations. Why? Because there's all that money yet to feed through into it from the broad money supply. The second thing it tells us is that we're only seeing the start of the effect on prices. I mean, today we had reported that the CPI was up 7.5%, which exceeded expectations of around about 7.3%. Shock, horror. But that's nothing compared with what we've got in line. And I know that you've spoken to John Williams before at Shadow Stats. And if you look at his assessment of where CPIU should be based on the way it was constructed in 1980, that's now telling him 15%. I mean, so These are huge figures. Now, what does it mean for interest rates? Well, what it means is that anyone buying US Treasuries on John Williams' figures is sacrificing in the sense that he's got a negative yield of around about 13%. And on even on CPI figures, he's got a negative yield of 5%. Now, can this continue very much longer? The answer is no. So you can see that a lot of people are turning around and saying, well, hold on a minute, the money supply growth is slowing down, and we've got to be careful. If the Fed goes too quickly, they will crash the economy and all the rest of it. That's not the problem. The problem is that prices still have to reflect a massive monetary impact, and that's shown by the difference on the chart between where GDP is and where M3 is in terms of relative growth rates. So this is a very serious situation, and I would impress on everybody to try and understand it. That is the mistake, really, about GDP. Now, when it comes to progress, which is really what we're interested in, that progress is something which, whereby the average person finds that his life has improved. I mean, okay, he works for it, tough. We've all got to work for it. But if he is prepared to work, he can earn, and not only can he earn, but he gets a better standard of living. That is what progress is about. And it's a combination of entrepreneurial profits, seizing on the opportunities, identifying what people want, identifying what's going to make people's lives better, combination of that and deploying technology. I mean, in theory, we've got it in spades now, but we haven't, because they're destroying the whole thing by printing so much currency, to try and rescue zombie companies, zombie governments and all the rest of it, that we're just being suffocated by current monetary policies. They're doing exactly the opposite of what they should be doing if they had our interests as the people at heart.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information, and it helps us spread that message. Sharing is caring. And now, let's continue.
Do you want to know one thing about crypto? I made over 3000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. The fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.